Happy Friday, happy December 1st, happy holidays. We have a great program for you today here at the Oracle Conference Center. My name is Roseanne Faust, and I'm the President and CEO of the San Mateo County Economic Development Association. We are doing this program in cooperation and partnership with Amy Buckmaster, the CEO and President of the Redwood City Chamber. Amy is back there taking pictures. I want to give her a big round because she's just a fabulous partner. I want to actually thank our teams. We have Carolina Webster and Dawn Greenblatt. We have Amanda Hawkins and Christina Fernandez. As you know, we can't put on programs without a great team behind us. So thank you, and please thank our team. So before I introduce Gary Schlossberg, and what I'm not going to do is I'm not going to read the bio. You have it. You have Jeremy Carl's bio. You're all really, really smart people, so you can read their bios. But what I'd actually like to ask each of the speakers to do, because I didn't have a chance, is just tell you, the audience, a fun fact about themselves. We've been doing that lately at some meetings I'm attending, and it really kind of gets people thinking, and it gives you another perspective of folks that are in the room. So they're going to share a fun fact with you. But we have to make, before we bring them up, we have to make some introductions. And what I'd like to ask is that the folks that I call out would please stand up so that folks can see who you are and recognize you. And if there's issues that they'd like to discuss with you, it puts a name to a face. That's a positive. Let's all be positive. This is the month of positive, okay? We can be whatever 11 months of the year, but frankly, for me, December, it's about being positive. So representing Congresswoman Anna Eshoo is her Chief of Staff, Karen Chapman. Representing Assemblymember Kevin Mullen is his District Director, Mario Rendon. Representing State Senator Jerry Hill is his Chief Aide, Joan Dentler. Representing Assemblymen, our newest Assembly member, Mark Berman, is his Chief Aide, Zach Ross. If you notice, they're at the Lucille Packard Children's Hospital. So there's a protection element that goes along with representing members of the Assembly and Congress. We also have our San Mateo County Controller, Juan Ragoza. Hey, Juan. We have our Mayor, Charles Stone, from the City of Belmont. We have our newest Mayor and Vice Mayor from the City of Redwood City, so congratulations are in order, Mayor Ian Bain and Vice Mayor Diane Howard. We have Councilmember Alicia Aguirre from the City of Redwood City. We have Councilmember Janet Borgens from the City of Redwood City. I love the fact that my town is well represented here this morning. We have Redwood City Port Commissioner Loriana Kastrop. So let's talk about our sponsors. Because again, it takes a team, takes a village to be able to put on programs like this. We are very fortunate this year to have a presenting sponsor. And our presenting sponsor is Wells Fargo. And I'd like to really acknowledge and thank Sunil Pandya, who is here with us here today. Be nice to Sunil. He has a very large brace on his leg. Don't anybody turn it, okay? Just be careful. Our other corporate sponsors, we would not be able to do programs as well as we do them without the Oracle Conference Center. So this is our thanks to Randy Smith and his team at the Oracle Conference Center. Randy, I know I saw you walk in. There you are. And then our corporate sponsors, BKF Engineering and Todd Adair, Bohannon Development Company, Bob Webster, the City of Redwood City, Melissa Stevenson Diaz, DPR Construction, Tracy DeLue, Kilroy Realty, Eileen Kong, Lucille Packard Children's Hospital, Sherry Sager, Recology San Mateo County, Mario Puccinelli, San Mateo Credit Union, Wade Painter, Sequoia Hospital, a Dignity Health member, Bill Graham, Sims Metal Management, Jill Rodby, Stage Rigging, Jeff Gilbert, Stanford University, Steve Elliott, the Sobrato Organization, Peter Sy, Universal Paragon Corporation, Jonathan Scharfman, W.L. Butler, Bill and Joel Butler. Could all of our corporate sponsors please stand up? You see their names pretty much everywhere, whether it's a business organization, or it's a nonprofit, or it's an educational institution, or it's out in the community. These are the people that make up our community, and we are so grateful that they support us. We also have 2 additional business sponsors, and that's United American Bank and Carl McClellan Law Firm. Frank Bartaldo and Norm Book, if you would stand up, we'd like to show our appreciation. So are you ready for this morning? Are you ready to hear about what the economy holds after the stocks went crazy yesterday? They're down slightly today. Gary Schlossberg, senior economist with Wells Capital Management, is going to come up. We're going to have Gary do a presentation. Then he's going to take some Q&A. Following Gary will be Jeremy Carl, who's a fellow at the Hoover Institute. And Jeremy's going to talk about Bay Area business in the era of Trump. And some of you in the audience know I've heard Jeremy speak before, and I'm very excited for him to share his thoughts about business, particularly in the Bay Area, in the era of President Trump. So without further ado, Gary Schlossberg.
Thank you. Thanks, Roseanne. Well, it's a pleasure to be back. I think it's been a few years since I last spoke to the group. Really nothing's changed on the forecast. Still forecasting moderate growth, in a word, higher interest rates to come. So far we've been half right. The interest rate forecast really comes under the heading of forecast something long enough and eventually it'll come true. We think that coming into 2018, we could finally see that turn in interest rates, but I'm sure that a year or so from now, if I do have the pleasure of being invited back, I'll be eating the same crow. A fun fact, I am an economist, and we just, Jeremy and I think just learned about including that in our remarks. I'm an economist. There's no fun in being an economist. It is the dismal science. I guess I would have to reach way back to my childhood. I grew up in Brooklyn, New York. I grew up in Flatbush. I was 2 or 3 blocks from Ebbets Field, and I remember the Brooklyn Dodgers. And I couldn't tell you who was in the World Series last year, but if you have a moment and you want to hear the starting lineup of the 1955 World Series, Game 7, it's like riding a bike. You just don't forget those things. So I think that's about the best I can do as far as a fun fact. What I'd like to do is give you a top-down view of our thinking on the economy. I'll be going through a few things very quickly, try to keep within the amount of time. I get up here thinking I'm being paid by the word, and I do tend to run over. And I do want to save time for questions, and Amanda was kind enough to include a couple of notes telling me when my time is up. So I may end abruptly if the past is any guide. But on the economy itself, I would describe the current situation as really sort of an old man river growth cycle. It just keeps rolling along. We're in our 9th year of economic growth. This is the 3rd longest expansion on record, and that record goes back to the 1850s. If we continue to grow into the spring of next year, it will become the 2nd longest. The silver lining to what really has been a very modest stop-go, somewhat disappointing growth cycle, considering the deep recession that preceded it, is that we haven't had the usual bottlenecks that have developed, notably higher inflation, higher interest rates, which tend to squeeze purchasing power, squeeze housing, and other interest-sensitive sectors of the economy. And I think to some extent that accounts for its longevity. In any event, where we are now, we're coming off a couple of quarters of solid economic growth nationwide, some of it overstated by the reconstruction in the southeast after the effects of the hurricanes to hit that area in late August to early September. The very recent economic data do suggest some slowing in economic activity, more likely a shift to more sustainable economic growth as we close out the year. The numbers are still holding up well, but that growth of 3.5% that we've had over the past couple of quarters, nothing spectacular, but by recent standards, a very healthy growth rate, we think is beginning to wind down. Taking a look at the San Mateo and the Bay Area more generally. I'm not a regional economist. I'm not a real expert on the local economy. Most of my remarks here are really more from 30,000 feet based on some of the national data that is driven down to the state and local level. But you can see that the winding down has extended to the Bay Area as well. This is simply year-over-year growth in employment, jobs, sort of a trend. We take a 3-month moving average, but you can see that clearly the trend has been over the past year or so, 18 months, towards slower economic or slower job growth in the area. How much of that is due to just a shift to a more sustainable rate after very rapid growth, as you can see, and through much of 2015? How much of it is due to more of a yellow flag indicating a shift, losing momentum, and a shift to more sluggish growth still remains to be seen. The yellow flags are, if you dig down a little bit further into the industries where growth is strong and growth is weak, there are a couple of yellow flags that pop up. I might add, we use job growth. Jobs aren't the best indicator of economic activity, but the advantages, as I mentioned in past meetings, very up to date. We have data through October and very disaggregated, both by industry and, as you can see, by region. Now, we don't have San Mateo data for 2017. It's lumped into the west side of the bay, San Francisco, Marin, and San Mateo. But if you look at that area, you can see that a lot of the strength is in construction activity. That's on the leading edge, along with education and healthcare. Construction is somewhat vulnerable if, in fact, interest rates begin to move up, squeezing housing affordability, perhaps undercutting commercial construction. So that's one potential yellow flag out there. The other, the area of weakness we're seeing, at least in the raw data, is in business services. And that's an amorphous category: data processing, legal, advertising. It tends to be very sensitive to the economic cycle, the ups and downs in overall economic activity. And the fact that it is winding down, growing at little more than 1%, could be an indication that of something more than just a shift to sustainable growth. Having said all that, the backdrop, the broader area that we're operating in, the Bay Area itself, very dynamic, good bone structure, clearly tech-driven to some extent, spilling over to more of the domestic-oriented industries, consumer, services, retail, construction, of course, benefiting from those low interest rates, suggests that growth will continue, but it likely will be at a more moderate rate. Nothing wrong with the housing market here. The year-over-year change in home prices, median home prices, these are data from the California Association of Realtors. You can see that the gains in San Mateo, that's the blue line, and I've got to apologize. I think I've mentioned this in years past. I'd love to fire my research assistant. My research assistant is me, and it shows in these charts. Nothing fancy, no bells and whistles. But the blue line is simply the year-over-year increase in San Mateo, specifically San Mateo County home prices against what's happening in Santa Clara County and San Francisco. And you can see that in Santa Clara, if anything, home price increases have actually accelerated based on that California Association of Realtor data, but nothing shabby about San Mateo. Those home price increases continue at a double-digit rate. The good news, wealth continues to rise for existing homeowners. That boosts spending power. The housing market being vibrant, reflected in those home prices, means construction employment, and more importantly, the ripple effect of strong housing on big-ticket spending, on housing-related finance, mortgage financing, real estate activity, the effect on employment, certainly supportive as well. The downside, of course, is these prices continue to rise at a rapid rate. We're already seeing affordability, which already was extraordinarily squeezed in California, always has been, but squeezed even further and making it that much more difficult for the first-time home buyer. But net-net, in terms of the outlook, near-term outlook, certainly a plus for the local economy. So looking ahead over the next year or so, while growth, we think, in the local economy will be fairly moderate, we think it is certainly sustainable. And that pretty much holds true for the U.S. as well. And that, of course, has an important effect on the local economy. What we're looking at now, as we look ahead to 2018, is an economy whose growth cycle, even in its 9th year, remains broadly based, well-balanced, and if anything, has begun to broaden out beyond that. This chart simply shows you the situation in manufacturing activity, that's the red line, and non-manufacturing activity, the dominant sectors, services, construction, everything other than manufacturing, accounting for about 85% of the economy. These lines represent purchasing manager surveys. We call these soft data because they're based on surveys. How are businesses feeling, rather than concrete orders and output and the like. And as you can see, in both for manufacturing and non-manufacturing activity, we've had a clear-cut increase over the past couple of months in both lines. Manufacturing has jogged a bit lower, but the important point is that when these readings are in the upper 50s, as they are now, and we'll be getting new data. Well, manufacturing data was actually out this morning, non-manufacturing next week. But when these numbers are in the upper 50s, that's normally consistent with moderately strong growth. So even late in the cycle, we've seen the economy actually picking up, businesses feel more confident, and that naturally improves the outlook for investment spending. And there, that outlook and the current data suggests that investment spending, which has been sort of absent without leave through most of this growth cycle, is beginning to come on. The blue line shows you equipment orders by businesses. And you can see that we've moved back over the last 3 months, sort of a trend at the margin, back to a double-digit rate for the first time in the last 3 years. The red line is something of a leading indicator. And we actually have data right through November. Based on surveys from the New York Fed, from the Philadelphia Fed, the Texas, the Dallas Fed does a similar survey. It's not comprehensive, but certainly the indications are that, if anything, the outlook for capital spending plans in those parts of the country, and of course by businesses that operate throughout the country, actually are picking up a bit as we move through 2017 and 2018. That's got to be good news for the Bay Area as well. It includes high-tech spending, which helps drive the Bay Area economy as well, much of it in software and the upper end of high-tech equipment. But it's this area, of course, where tax reform is directed. The real driver of tax reform, lowering corporate tax rates, full expensing of capital equipment, which is really at the heart of the tax reform debate as it's playing out at the moment, really designed to focus on expanding investment, allowing investment to contribute more to economic growth. And frankly, there is that tailwind very late in an economic cycle because investment spending is already picking up. The big question mark is what impact tax reform would have on this rotation toward investment spending. Some people argue that tax changes, tax cuts, play only a relatively small part in investment spending decisions. You have to have the economy moving ahead. You have to have operating rates on the rise. Deregulation, according to a number of studies, plays a more important role. But certainly, there is that tailwind. The economy is holding up reasonably well. We have a synchronized global growth recovery, providing more opportunities for capital goods producers in this country to export overseas, and we're seeing strength there. But some questions about, first of all, what will tax reform look like if and when it gets through Congress. The momentum was stalled yesterday by some issues about what effect it'll have on the deficit, and some specific issues that raising some concern among senators. And out beyond that, of course, what effect it will actually have on investment spending down the road. But certainly for now, at least, the actual numbers are showing this broadening toward a more capital goods-led economic growth cycle, which I might add is fairly typical. Capital spending, investment spending, tends to be a late cycle sector of the economy. Along with state and local spending and commercial real estate, these are the areas that usually pick up the slack created by big ticket spending, which is normally strong early in a cycle, autos, housing, and the like. And we're seeing some of that taking place, certainly in business investment, less so with state and local spending, commercial construction, commercial real estate, more front-loaded in this cycle, and is not providing the usual lift late in an economic cycle. In any event, our forecast for the coming year is that growth does slow to a more sustainable rate. We're not looking for a recession. There are certain risks in the outlook, but more moderate, sustainable growth of about 2 to 2.5%. For the U.S. as a whole, this is more in line with our long-term growth potential. We would call this, I would call this, adequate economic growth, strong enough to make further inroads against the unemployment rate, and by itself, adequate enough for the Federal Reserve to begin raising interest rates. More on that in a moment. But why don't we expect more? Well, just one other quick point about the local economy. San Mateo, we think, is reasonably well positioned for to remain on the leading edge of growth in California and even in the Bay Area. This chart simply takes a look at the economic cycle dating back to June of 2009, the beginning of the economic recovery. Again, using employment data right through October. For San Mateo, the data for 2017 have been estimated. We do have monthly data for the county right through the end of last year. And we've extrapolated that based on some of the other data that we have. The horizontal axis is average annual growth since June of 2009. The vertical axis is volatility, the volatility of that growth. And the point I would make is that, first of all, risk volatility-adjusted growth, job growth in San Mateo, has been relatively strong, exceeded only by Santa Clara and San Francisco. If you're an investor, this is risk-adjusted returns, in effect, for the local economy. The good news is that we do have a good head of steam, and historically, San Mateo has had quite a bit of momentum, not surprising given the mix of industries in the area. The downside to that is that if there is a disruption to the economy, San Mateo's economy does tend to be more highly charged. That higher volatility does leave it vulnerable to what I would call more of a hiccup than anything else. The backdrop for San Mateo, the inherent strengths of the San Mateo economy are such that we should continue to see reasonably good growth, and if the economy does stumble, a reasonably quick rebound, much as we saw after the dot-com bust in 1999 and 2000, and to some extent after the meltdown in the financial markets and the deep recession in 2008, 2009. We were hit hard in both instances, but if you look at the path of San Mateo relative to the rest of the economy, you'd find that the growth rate came back sooner, and the growth rate was a bit stronger. Getting back to the economy, the national economy, however, as I said, we're looking for more moderate growth. We don't look for the economy to continue growing at that 3 to 3.5% rate that we saw over the past couple of quarters. A couple of headwinds out there. For one thing, we're late in an economic cycle. The real strengths in the economy, the burst of pent-up, the release of pent-up demand, the burst in the housing industry, we think are pretty much behind us. The economy's growth rate is broadly based, but some of those early engines just aren't there. Secondly, we're dealing with some structural weaknesses, which I'm sure you're familiar with: labor force growth, an aging population, more recent immigration controls beginning to bite a bit, weighing on our growth potential. Growth potential is simply labor force growth and productivity growth combined. And both of those are growing at a moderate rate. I might add, with productivity growth, given the innovations out there, taking the longer view, if the past is prologue, we think that we will see that productivity growth rate pick up. But given the lags between the introduction of new technology and its effect on the economy, it's about 10 years after the electrification of the economy, transportation innovations about 100 years ago, before it really began to show up in our growth rate. We see something like that being replicated down the road, but for now at least, something of a headwind. And of course, all the uncertainties about economic policy could raise some issues as well. The other element in the outlook, really more a threat to economic growth, we think, is a replay of what we saw about 10 years ago with a disruption in the asset markets. In fact, that would be a segue to some of the less traditional risks, turning to those risks in the outlook as we move through the 9th year of an economic expansion. Most of the risks tend to be more non-traditional. The bigger threats, the more apparent threats over the years have been the rise in interest rates and the rise in inflation that I mentioned earlier that tend to squeeze the economy and wind down economic growth. We don't see that operating through 2018. But the risks that we are looking at are in the financial market. Asset values have been inflated to some extent by an extended period of ultra-low interest rates, investors reaching for yield, reaching for return in riskier assets. The risk is that as interest rates begin to move up a bit, begins to squeeze those asset values. And if you do get an unraveling, as we did a decade ago, that could have a disruptive effect on household wealth, business spending, businesses hoarding cash as they did. We don't see a replay of that. We think the similarities in the financial markets today, and there are many, to what we saw a decade ago, are really more by nature rather than degree. But we could expect to see some turbulence in the market, and that could trip the economy up sometime in the next 12 months. The second risk out there is that despite low interest rates, the economy is in a way more interest sensitive now than it has been in years past. Take the housing industry, for example. Again, another gem of a chart, left scale, right scale. The red line, median home prices. That's using the left grid, prices in thousands of dollars. The right side is a ratio. It's monthly payments on the median priced home. This is nationwide as a share of median family income. And you can see that from the red line, home prices are already above their previous peak back in July of 2006. In effect, filling a vacuum created by those low mortgage rates. Affordability improved as mortgage rates came down. Qualifying incomes were lowered a bit. And we saw demand increasing, boosting those home prices. You can see that at the same time, the actual payment, where the rubber meets the road on affordability, because mortgage rates are so low, the current payment burden, monthly payments as a share of median family income, little more than 15.5%. When home prices last peaked in July of 2006, even though they were lower than they are now, that repayment burden was up around 25%. That's been good news for the housing industry. Turning that on its head, however, once interest rates begin to rise, you're applying a higher interest rate to a much larger home price, and that boosts the monthly payment. Doesn't have an overriding effect on the housing outlook, but it can act to slow increased demand. For an existing homeowner, of course, locked into a fixed rate mortgage, has little impact. They're riding the rise in home prices, their wealth is increasing, but it just creates a bigger hurdle for the first-time home buyer or even somebody that's trading up. The last risk in the outlook, we think, is more cost-driven. We've been operating for years in an environment of low inflation, disinflation in the economy. And as you can see from this chart, the blue line is simply the year-over-year increase in selling prices. That's pricing power. The red line is the increase in unit labor costs. Unit labor costs have been rising more rapidly. Even though both have been slowing, unit labor costs have been rising more rapidly than prices. Pricing power has been weakening. The result has been a squeeze on margins. If we don't get an improvement in prices, margins continue to be squeezed, you could see businesses imposing a greater restraint on wage increases and even on new hiring. Well, that's the raw material for income growth driving consumer spending. So we do see this as a risk more in slowing economic growth as we move through next year. The good news is we think that inflation will be turning the corner. As usual, I've been speaking longer than I should, so I'm going to just jump ahead and get right to the interest rate outlook. So much depends on inflation. Inflation has been very subdued so far. Looking ahead, three broad elements we think will drive the inflation outlook. One is the outlook for oil prices. And our best guess at this point is that oil prices will be steady to higher as we move through next year. OPEC has just announced, in conjunction with Russia, an extension of its production accord, holding back about 1.8 million barrels a day of oil from the market. That's already had the effect of lowering inventories. Demand is expected to moderate, but still hold up and grow next year. The $64 question is what happens with shale output. The shale producers are coming under greater financial pressure to restrain output because of the return on investment, and we may not see the big ramp up in output that we've seen in the past when prices move up. So we're calling oil neutral to slightly negative for the inflation outlook. That is perhaps underpinning inflation. The second element out there is the outlook for wages. Services inflation, more than half the CPI, very labor intensive, very wage sensitive. And as the labor market continues to tighten, wage pressures we think will build. We're already beginning to see some evidence of that, and we think that will be more of a driver. The third element, goods prices, very trade sensitive, sensitive to foreign competition. A lot has to do not only with the global economy, but with the dollar. The dollar has weakened over the last 6 to 9 months. The global economy is strong, less incentive, less need for foreign producers selling into this country to lower their prices to boost their market share. When you put all those things together, we think inflation will be moving gradually higher. All in all, we think that will provide something of a tailwind for a gradual rise in interest rates. We say gradual because we think the Fed will be very cautious in raising interest rates. The financial markets are under some strain after years of ultra-low interest rates. If rates begin to move up, that could create some turbulence out there. The Fed, this unholy trinity on economic policy, I was going to explain that, but suffice it to say that the Fed has to balance. Its mandate is stronger growth, price stability, and they seem to have achieved that. But the third element out there, not part of its official mandate, is asset price stability. And if they're trying to boost the inflation rate by pumping a lot of money into the system, that has the effect of boosting asset values, as we've seen over the past couple of years, creating the conditions for greater asset market stability. As they raise interest rates with inflation moving up, that does pose a threat to the asset markets, and that could create greater volatility. And that's why we're looking for that bumpy ride higher. As we normalize interest rates, as we move those rates gradually higher, there will be distortions that are unwound in the financial markets. Pension funds, insurance companies have been reaching for yield, not out of greed, but just simply to match their liability targets down the road, getting into riskier investments with higher returns. As those yields slowly move up, you're going to see portfolios rearranged, moving more in line with underlying risk tolerance, moving into higher quality investments. And those shifts within the financial markets, we think, at the very least, will be creating more volatility. We're looking for longer-term interest rates to move up as well. The middle point, due as much to higher inflation as to a change in the technicals in the market. The Federal Reserve has been a big source of demand out there. They're beginning to pull back a bit. Deficits are beginning to increase, or already rising. They could rise even more rapidly with tax reform. And that means the supply of securities will be going up. And that could have the effect of putting upward pressure on interest rates. I have a chart pretty much outlining how interest rates are expected to play out. These are called yield curves. They're just the path traced by interest rates at different maturities. Basically, what I'm trying to show here is that And this is based on the futures curve, that is, what the market is looking for in interest rates over the next year. The point I want to make is that the bigger increase in rates is expected to come from shorter and intermediate rates, longer-term rates driving fixed-rate mortgages, longer-term bond yields, we think will rise far more modestly given the gradual rise of inflation, and that should have a cushioning effect on the housing market, even as it squeezes affordability. I think I've pretty much run out of time, even though I'm talking a mile a minute. I'll just put up the summary points in our outlook based on some of the points I've made. But at this point, if we still have some time, why don't I see if there are any questions out there and try to answer those.
We have time for a few questions, probably about 2. So, anyone have a question? This audience is never shy. So somebody, okay,
in the
I
back?
see.
So, several years ago, there was all some talk about government backing out of the purchases that was going on. And that doesn't, that would have a big impact on the market. That doesn't, I'm okay.
Okay.
We can't hear you. Okay. The question is thank you. The question is, 2 or 3 years ago, there was a lot of talk about the government winding down what they were doing and, stimulating the economy. So that's happening now, I think, to some extent, but it hasn't really had any impact. And there was such talk that would have such a big impact. Can you summarize what happened or what's going on?
Well, through much of the cycle, we were still dealing with a large budget deficit created to try to jumpstart the economy out of a very deep recession. You may recall some of the measures that were taken in the aftermath of that very deep recession. I think since then, the economy has performed much as it normally does. The private sector picked up a lot of the slack. We did see confidence begin to improve, big ticket spending improving, low mortgage rates helped jumpstart housing activity and other interest-sensitive sectors of the economy. So the government was able to pull back. The downside to that is that the budget deficit as an issue moved off the front pages in relation to the economy's size, not a big issue, even as debt continued to creep higher. We've lost that discipline a bit, and with this tax reform, we will see an increase in the deficit of about $1.5 trillion over the next 10 years, on top of a natural increase in the deficit associated with an aging population, a big increase in entitlements payments. But the government is trying to step back in and trying to jumpstart or stimulate growth above and beyond what we've seen before in a healthy way through investment spending. Whether or not it's successful remains to be seen, but the concern many of us have is that a deficit, a debt burden, which is already fairly high and vulnerable to the same interest rate increases that I mentioned earlier, lathered on top of a deficit that was already set to rise because of an increase in Social Security, Medicare, other entitlements payments, could create an issue down the road for the government. But the private sector so far has done their job in stepping in nicely, much as they normally do in a cycle. Yes?
Janet Yellen's on her way out, and as we said, she's coming in. Any comment related to the prognostication you have about Fed?
Yeah, one of the uncertainties in the outlook is what kind of Trump Federal Reserve we're going to be looking at. How hawkish? Is it going to be more hawkish than the previous boards? Probably won't really come into play unless at the margin there may be a reason to raise interest rates more or less rapidly than we might otherwise expect. There are 4 openings on the board. One may be filled sooner than later. Marvin, good friend, a bit more hawkish than the replacement, or certainly adding to the hawkish vote on the board. If that kind of trend continues, we could see a board that, at the margin, given the conditions out there, may be more inclined to raise interest rates a bit more rapidly than the Fed might otherwise under the past board, which tended to be a bit more dovish, more cautious in raising interest rates. The other element of policy, winding down the Fed's balance sheet, the big increase in assets from quantitative easing. So we're keeping an eye on the appointees to the board. Keep in mind that The policymaking FOMC also includes Federal Reserve Bank presidents, and at the margin, they rotate each year, and the incoming group of Federal Reserve Bank presidents at the margin a little bit more hawkish to begin with than those that are being replaced. We also have the Federal Reserve Bank president from New York that always sits on the board, and that's another wild card out there. The president won't nominate that person, but again, that could help tip that balance as well. So the policy outlook to some extent also depends on who's appointed over the next year. The early returns suggest that maybe a little bit more of a hawkish bent and more aggressive in raising interest rates than the board, the people that they're replacing.
One more question. This will be the final question.
All right. So Gary, can you comment on, so the Feds, they're, basically taking this, the monetary policy and I guess a more, the impact of their monetary policy seems like it's going to dampen the economy, right? With, rising interest rates, and I mean, that's what they're doing. And then on the other hand, fiscal policy with the tax changes is supposed to be stimulating the economy. I guess, can you comment on just, the contradictory impacts of monetary and fiscal policy?
Well, it's not unusual for the two to work to some extent balancing one another. We've relied on the Federal Reserve to stimulate the economy over the past couple of years. It's done so in an extraordinary way, a very aggressive stimulus. It's created some imbalances in the economy. We would hope that the Fed would begin to pull back in any event. At this point, fiscal policy, which really has been more neutral, maybe even leaning against the wind a little bit as the deficit has come down, as it normally does with the economy growing, tax revenues rise, unemployment insurance benefits, things related to weak economic growth begin to wind down as well. There is a little bit of, some would argue there's a little bit more of a reserve now that the economy may be shifting toward a more moderate rate of growth again. We may need some stimulus, the argument goes, from somewhere to continue to rely on the Fed, and with the downside that it has on potential instability in the financial markets from allowing asset values to build up with these low interest rates, more of a risk in relying on the Fed to stimulate the economy. So it's really more a change in the mix between fiscal policy and monetary policy, not really necessarily working at cross purposes with one another. I mean, if if fiscal policy was becoming more stimulative, as it probably will be if the deficits rise, and the Fed continue to keep its foot on the accelerator, we might end up overstimulating the economy, and then you run the risk of inflation, or at the very least, further distortions in the asset market. So I think it's certainly appropriate that you get that rotation. The question is, how aggressive are we going to be? What does it mean for the budget deficit down the road if we're already seeing that deficit increase? Thank you very much, everyone.
So let's give Gary Schlossberg another round of applause, way louder than that. So one of the things is that I absolutely love emceeing events like this because it allows you, one, to learn, and it also allows you to sit over there at the side and remember that you forgot to introduce a few people. So I'm going to do that right now. We have council member and former mayor John Siebert was with us here today. I think he might have left. We also have two other former mayors in Redwood City. He was probably insulted I didn't introduce him since I hugged him hello. We have Jeff Ira and Jim Hartnett, former mayors in Redwood City. How about everybody stand up and we're just going to clap for all of you? Let's do that. So now we're going to bring up Jeremy Carl, who is a fellow at the Hoover Institute at Stanford University. And Jeremy's going to talk about Bay Area business in the era of Trump. Let's give Jeremy a warm welcome.
Thank you so much. Thank you so much for having me here today. This is going to be sort of and now for something completely different in Monty Python parlance, for those of you familiar. and I'm glad that Gary Schlossberg set it up really nicely by talking about fundamentals, because this is going to be a much more kind of big picture look at some of the interesting trends going on. And I should say, this actually comes out of a presentation I'd originally given to the Bay Area Council Economic Institute, to a much smaller group. It was one of those presentations where you kind of wanted to be invited, but then you weren't sure that you really wanted to be invited back. And so, I just kind of wrote this thing that it was sort of like, at the end, it was sort of, if there's anybody I haven't offended, I apologize. But much to my surprise, everybody came up afterwards, and it was some of the nicest comments I've ever gotten on a talk I gave. And among them was Roseanne, who was in attendance, and asked me to kind of, would I be interested in sort of doing it again for this much larger group. So this is a modified version of this, and I'm delighted to be here today, and hope at least it will be thought-provoking. So I've titled this "Casualties of America's Cold Civil War," which is sort of a provocative title. Cold Civil War is Angelo Codeviglia is a conservative political scientist, kind of very well known in the field, and he's used this to kind of describe the era that we're in right now. Then I think it has a certain kind of resonance, I think, that folks will understand. I mean, we have just a lot of national political tension in a way that's certainly not unique in American history, but it's not, I think, as somebody who's very involved in politics, just kind of your average give and take and back and forth. And so what does that mean for the Bay Area? So introductory matters really quickly. This talk will probably be a little different. I need to say out front, views are very strictly my own here, not the Hoover institution. Hoover has no views on anything institutionally. Not the administration, although I do talk to them. And I have an ideological point of view. I'm a conservative Republican. I'm not, which is sort of like a white rhino here or something. But it's not my goal to give a partisan speech. And so I'll keep that in mind. I don't want to focus too much on the president, as tempting as that is. Love him or hate him, Donald Trump is just not the most important part of the Trump phenomenon, which is something that is part of a broader global nationalist populism that I think we're seeing. And so I'm not allergic to talking about him, but I don't want to get too focused, because you can sort of spend your whole life kind of having very strong opinions about Trump one way or the other. So it's going to be more of an impressionist portrait than a comprehensive overview of some of the things going on. I'm going to talk about structural weaknesses of California and the Bay Area, and the strengths are well known. I mean, I don't need to tell anybody in this room about the strengths of our local economy, our local society, but I want to talk about where I see some of the kind of the concerns. I'm going to talk about immigration policy, left and right, and I'm going to do a few thoughts on taxes. And were any of my senior Hoover colleagues who are economists here, they're going to understand why it's only a few thoughts, because they're infinitely more qualified to do that than I am. Mine are going to be more contained toward the political, which is something I do know. I can't obviously forecast what it's all going to do for individual businesses, but I will give you a few thoughts just because it's so current at the moment. So I want to start with a joke from Chinese social media that was making the rounds a couple months ago. Chairman Mao in this joke has sort of come back to life and is talking to the Chinese people. And he says, Chairman Mao says, "Can the people eat their fill? There's so much to eat, they're dieting. Are there still capitalists? They're all doing business overseas now. Do we produce more steel than England? Tangshan alone produces more than America. Did we beat the Soviet Union? They dissolved it themselves. Did we smash imperialism? We're the imperialists now. And what about my cultural revolution? It's in America now." And, again, you could take that vote. I think it's sort of funny from either side. It's just indicative of, I think, the ferment that we have going on. And again, this circulated. This is so popular on Chinese social media that even made it into my English social media account. So let me talk now about the risk for the Bay Area and Bay Area business. We're the most politically one-sided U.S. metropolitan area in a very polarized political climate, where, by the way, the other party has unanimous control over all three branches of government and the largest number of state legislators they've had in 100 years. So that creates some interesting challenges structurally right there. The middle class is fleeing California, particularly the Bay Area. I'll put data behind that in a little bit in my talk. We have increasing power of the tech industry, and abuses, real or perceived, of that power are beginning to generate some real political blowback. And I think that blowback, I think some people here are aware of it, but I think Too few, and they're not kind of aware of how big that blowback is right now. And there's an increasing disconnect, I think, between the nominally progressive policies of the Bay Area and the way in which the winners in the Bay Area actually live. And I think that presents its own risks. We can talk about that more later. And then finally, I'd say the Bay Area is a highly globalist community in what I think is going to be an increasingly nationalist age. And that's why I say it's not about Trump. What you can see, some of these nationalist trends, they're happening in Europe, they're happening in Asia, they're much broader. And for a really hyper-globalist place like the Bay Area, I think that represents a unique set of challenges. It's not insurmountable challenges, but I think we need to recognize where I think the general zeitgeist is heading and how we're going to address that. So why should we care in Silicon Valley about the Bay Area bubble, which is a very pleasant bubble to live in, as every one of us knows? So in the wake of continued abuses of monopoly power around consumer privacy, free speech, et cetera, by what's going on in tech, that's obviously an editorial comment on my view, not necessarily everyone would share that. Many conservatives, including me, have joined a significant number of voices on the left in calling for regulating the internet monopolies and oligopolies like public utilities, or even in some cases, this is not me, breaking them up entirely. I don't need to tell anybody in this room that if something like that happened in any serious way, it would certainly have a number of spillover effects on this area. So I think that's just something to keep in mind of not everybody sees things the way we see them here. Again, that would have profound risks on the Bay Area economy. And this movement is building momentum, and currently I think companies are largely flat-footed. I know there's stuff going on in the lobbying world, because I do see that a little bit up front. But in terms of the public perception, there's not a lot of movement. Ajit Pai, who currently chairs President Trump's FCC and is very knowledgeable about these areas, whether or not you agree with him, he recently kind of put a thing across the bow on this net neutrality debate, where he basically called out Twitter and said, hey, you're part of the problem. There was even some, he wasn't trying to implicitly threaten, but there's some clear implicit threat to the way Twitter has done business that was in his comments. And I think that reflects the view, certainly of the administration, but I think it also reflects the view of a lot of folks, regular folks outside the administration. So now let's get away from tech. Here's the reality of the Bay Area economy for many workers. This picture was in the Chronicles a few months back. This is Sheila James making coffee at 3:15 a.m. before a commute from Stockton to San Francisco. Gary Schlossberg talked a lot about the kind of upsides of high real estate prices early, and those are true. We shouldn't wish those under the rug. But some of this that we're seeing is some of the downsides of that. And I would argue that those downsides right now, despite whatever benefits you get from high asset prices, are sort of more significant in people's actual lives. Let me talk about the changing composition of income growth. This is not a Bay Area chart. This is a national chart. This is from Thomas Piketty, actually, a left-wing economist who's gotten a fair bit of publicity. But on the far left of the chart, you have kind of the income growth that accrued to various groups. The first is in 1980, and what you see from that chart, which is the light blue, is that kind of the poor and middle class used to be seeing the biggest income growth 35 years ago. There was actually less growth at the very top. And then in 2014, you see that same chart, there's less growth, almost zero growth for folks at the bottom. And then you actually see a fairly, small linear thing, kind of going up on that red line, and then it goes almost vertical, right? So I think there's two stories here. One is that the distribution of the income is a lot different than it used to be. But second is you don't have a vertical line anywhere on that 1980 chart. We've got a lot of people hitting those red dots here in the Bay Area. And that has a lot of positive spillover effects in certain respects. But again, I think it creates also, or it's reflective, I shouldn't say it creates, of some of these other dynamics where a lot of the benefits that we're getting in the Bay Area are not being equally shared or even vaguely shared by the vast majority of folks here, even though there's obviously a lot of affluence. So that's my way of saying that I think the California Silicon Valley model is working for businesses pretty well, but it's not working for people. California has the highest percentage of people living in poverty in any state, according to the Census Bureau's new calculations. They have basically a more effective way that they've started using in the last few years of calculating poverty. That's something that not a lot of people know. So, I think it's pretty staggering when you think of all the states out there. A small leader doing spectacularly well, that was some of those red dots on the chart. And there's a good-sized upper middle class who's doing well, but they're anxious. And I think there's a massive and growing underclass in this state, and to a lesser extent in this area. We have a top 5 national ranking for percentage of schools ranked by the Department of Education as among the nation's worst, top 5 among the 50 states. Fertility and family formation is well below replacement. This is a note from my colleague Raj Chetty at Stanford, who's a very kind of huge up-and-coming economist. Women who grew up in the Bay Area are much, much less likely to be married than if they grew up somewhere else. So if you're in your mid-30s, only something like a quarter or less of girls growing up in the Bay Area are married. And we show in our paper that every additional year you spend growing up in the Bay Area, you're less likely to get married. For you, those of you with kids, which I have, that's not an entirely theoretical construct, that paper. That was a matter of personal interest. But I think it's indicative of a broader affordability crisis of doing the sorts of things that are foundational to civilization. Getting married, having families, for the next generation. What does that all look like? And I think lost in some of these great top-line numbers and in the Googles and in the Facebooks, et cetera, is things like this, is numbers like that and trends like that that are more worrisome. So California and the Bay Area have become, in my view, very family unfriendly. California's birth rate has declined to 12.42 per 1,000 population last year. That's the lowest in state history. Just to give you a sense, in 2010, we were coming out of a recession, and it was 10% higher almost. And it wasn't that high back then, okay? But it's really gotten quite low. And that includes, by the way, immigrant fertility, which is almost uniformly higher. So because of fertility opportunity and things like that. San Francisco has the lowest percentage of children in any city in the entire country. I call it Disneyland for adults. My childless sister has fun with that term. She also enjoys living in San Francisco. But are we kind of creating a family environment? Academic studies show a very high correlation between unaffordable housing, low marriage rates, and Democratic vote share. It's hard for me not to put a value judgment on that personally, but I'll just leave that out as an empirical observation. This is a very, very liberal area, and we have very unaffordable housing and low marriage rates. And for most large families, it's unworkable to live here. My wife works 2/3 time as an emergency physician. I'm well compensated as an academic. We make very good salaries. We have 5 children. We're a big family. And we struggle with the costs of raising a family in the Bay Area. I don't mean to compare our situation at all. I mean, there are a lot of people who are really struggling. We struggle like we have a house in Palo Alto struggle. So, this is not like the struggle is real type thing. But it's still hard. And it's hard to the extent that we actively think about relocating. Because it's like, I could live a really, really good life in a lot of other very attractive places. Or I can kind of do a little better than month to month and paying the bills, certainly. And we have opportunities for recreation and all that stuff. But it's not like all roses, and it's not like I've got 5 private college tuitions, paid for in my savings, okay? And we are very well off compared to the vast majority of people, and we recognize that. So, if a larger family like ours is making that calculation, you can imagine what sort of calculation the vast majority of families are making in an area like this. And for even those who can afford to live in the Bay Area, and this is another part of my calculus as I think about where we're going to be, what about my kids? Okay? I mean, forget Palo Alto. That's never going to happen. I'm like, I tell them, good, you better start coding right now, 11-year-old, because, it's just, otherwise you're not going to be, getting $2 million for your bare piece of dirt in Palo Alto. You're not going to be scraping that together. So, when you think about a place where you can basically tell your kids, forget about living where you grew up, the town you grew up in, which I'm sure a lot of you, some of you have at least some attachment to. I mean, that's pretty sobering, right? So I think we have to be honest that that's the environment we're increasingly in the Bay Area. So more evidence of California's broken model. Public Policy Institute of California says in addition to the nation's highest poverty rate, another 20% of Californians are in near poverty, which means they struggle to pay for food, shelter, or other necessities of life. Again, very different grade of problem than what my family has, obviously, but just another indication of some of the challenges. 1/3 of our state's residents are on Medi-Cal. This is actually a deflated number because largely, until very recently, if you were an illegal immigrant, which is a substantial portion of California, you weren't eligible at all for Medi-Cal, I mean, except for some certain emergency things. So it should actually be even higher. And with respect to poverty, basically, California is Mississippi with better beaches and taller mountains right now. I mean, that's the reality. And I got to tell you, actually, the beaches in Mississippi are pretty nice. I've been to them. So you can swim in them a little more comfortably than you can in California. So the Bay Area job gains are unbalanced. The data I'm showing here is from the LinkedIn Workforce Report, which for those of you, this is a fascinating data tool, by the way. I have to thank LinkedIn for the guys putting this together. They do it every month. This is a couple months ago. But it hasn't really changed. So what you're seeing here is the net growth per 10,000 workers. These are the 10 biggest metros sending workers to the Bay Area. So when you look at this chart, you see a couple of things on a net basis, not a gross basis. You see two places in India, maybe not surprising, right? Like a lot of tech workers from India. Los Angeles, again, not so surprising, that's the huge metro area right next door. And then everywhere else that we're getting jobs from is kind of big, obvious metro areas on the East Coast, blue states, not necessarily always the most dynamic economies right now. And then we've got a couple of sort of Rust Belt, Chicago, Detroit, Pittsburgh type thing. That's where we're drawing from right now on a net basis here in the Bay Area. That's who's coming here. Where are we losing jobs? That's what happens when you do the edit at like 1 in the morning. So we're losing hobs and jobs to attractive and affordable metros. See, Gary has a better research assistant than me. In any case, what you see here, where are we losing folks to? You see a big net drain to Seattle, Portland, Denver, Austin, right? Some of you who think about who's our competition in a lot of the tech world, right? We're losing folks to these people right now, these areas. And then some of these other kind of Intermountain West. Interestingly, people are not going east from the Bay Area. I think once you get out west, you kind of like it out west. But that's where we're losing folks to. I'm going to throw up Denver here as a contrast because I think this is what represents the balanced growth we don't have here. I could have done the same chart for Austin. I probably could have done it for Seattle, but I just didn't pull it up. When you look at Denver, not only are they getting a net significant thing from the Bay Area, but Houston, Dallas, St. Louis, Atlanta. I mean, there's a much bigger geographic and cultural diversity in terms of the places that Denver is drawing from right now. And I think that's what a more healthy Bay Area economy, a more balanced Bay Area economy would look like in terms of where it's drawing people from and where it's losing people to. And that's where we're not today. And I just think we need to be honest that we're not there as we talk about some of these other kind of trends that look positive. So now I'm going to talk about immigration. This isn't a subject I write a lot about professionally. I'm just going to really just sort of touch on some basic observations on left and right. So immigration was the defining issue for Trump. It just was, positive or negative. 37% of Silicon Valley residents are immigrants. It's kind of a staggering number to me. Even living in Silicon Valley in a plurality Asian American school district, that number is kind of staggering to me. More than 1 in 20 Bay Area residents is an illegal immigrant. And a successful compromise on immigration legislatively, I think, will result in an immigration policy that, in my view, needs to serve the interests of Americans first and foremost. And that, regardless of the fact that people are not going to agree on what Americans' interests are, I think that's where we need to get. And generally speaking, the Bay Area business community and organizations representing it, in my view, have not been serious about doing anything that comes to a real solution that would actually be persuasive to voters on the right who are angry about the immigration situation. There's been no serious attempt at compromise. I'm not going to call it. I had organizations called out when I did the previous version of this. I didn't do that because it's not productive for a public audience. But I mean, I'll just throw that out. And I say this based on the fact I talk to people at the highest level of this administration on these issues. So I have a good sense of where they really are, not where they might say they are in a public debate, but where they really are to get something done. And I certainly have a good sense of where we are in the Bay Area. And I think, as an example of this, there was the reaction to the RAISE Act RAISE Act was put out by Senator Cotton and Perdue. It basically puts the US to closely mimic, the great fascists in Canada and Australia in terms of their immigration policy. I mean, it wasn't a radical act, but yet there was sort of this hysterical reaction. And you would have thought like Nazis were, like stamping everybody's passport the way it was sort of reacted to in the public sphere. So I just think we're a long way from a productive and serious conversation about it when suggesting a Canadian or Australian style immigration system kind of engenders that type of reaction. Again, contrary to popular rhetoric, statistically speaking, again, I could back this up if we had time, it's relatively easy to identify in advance those immigrants who are likely to be key contributors to key areas such as technology. And those immigrants right now make a small percentage of our total immigrants. And we need real H-1B reform for lots of reasons. And in a previous life, I was in tech business. I was bringing in, I would do an M&A where we were bringing in companies with H-1B software engineers. So I've seen both sides of this issue. There have even been some reasonable bills that have been put forward on this right now, but we're not there yet. And there are some basic things I think we could do that without eliminating the need for us to draw international talent, which we absolutely need to do, and I don't need to, again, tell anybody in this room that we need to do that. We could do something very different than what we're doing now. I think the business community continues to use very unhelpful rhetoric about jobs Americans won't do. Okay, I love my job, adore it, great job. Would not do it for 10 bucks an hour. Wouldn't do it for 20 bucks an hour. Wouldn't do it for 30 bucks an hour. Wouldn't even do it for 40 bucks an hour, okay? I'm not saying that's true, obviously everybody has their different price point for everything, but when we talk about jobs, that's like a red light to folks on the left. It's like a big flashing red light. Because what you're really saying when you use phrases like that is jobs that they won't do at the low price I want to pay them to do it. And my view is like, we should pay our workers like a lot for jobs they do that are hard and not necessarily the world's most attractive jobs, right? Like, I always point out to my kids, I'll show them folks working in a restaurant kitchen. I'll be like, look how hard those guys are working. And you know what? They're not getting paid very much. And partially it's sort of like, be careful that you don't wind up at a job where you have to work really, really hard and not get paid very much. But it's like, wouldn't it be nice if we paid people a significant amount to work hard jobs? And it's not that I'm naive to the point that we don't have infinitely elastic labor markets for these things. But could we have a redistribution of a certain amount of income for capital and labor? Would that be like a really bad thing in the US given the income inequities that I showed up there? I don't personally think it would. So I would say, this is a Democratic area, and I think Bay Area businesses, and this is a voice that you guys have, need to tell the Democrats who represent them that they want the vote and not the issue, we can move to a more constructive approach on immigration. For those of you familiar with the parlance that I've used here, you talk about sometimes in politics whether you want the vote or whether you want the issue. And the vote means you actually want to pass a bill. You actually want to get something done. And the issue means actually we just kind of want to posture about it because we think that posturing is really good. We know that we're not actually going to get anything done, but we think it's good politics for us to kind of beat up on the other side in that way. And I think that's kind of where we are. I'd say that's where we are in parts of both sides of this issue right now. But I think if the business community tells folks that they really want the vote and understand that that's going to involve some compromises that they're not necessarily going to love universally, I think we can get somewhere. DACA, this is the Deferred Action for Child Arrivals, sometimes called the Dreamers, illegal immigrants or others with long-time residence in America. The fate of those folks is not the thing keeping a deal on immigration from getting done. And again, I'm not going to get into that, but this is based on, again, I talk to people who make these decisions in this administration, and I have a good sense without, revealing too much inappropriately of what folks redline. This is not actually a big secret. President Trump has said as much. He sort of pushed off the DACA enforcement and said, hey, let's get a deal done so that we don't have to do something. So I'd love to be hopeful that we could get it done. So that's the economic component of immigration. Let me talk a little bit about immigration because I think unlike Texas and Florida, the two biggest states are sort of two biggest kind of the other states out there that are also growing quite rapidly. California has a very unbalanced migration pattern. Just an example, so 2005 to 2013, Texas gained 4.8 million domestic migrants. That means people coming from other states in the union, and 1.1 million international migrants. So like, pretty good story, very popular for lots of people, both in the US and elsewhere. 2000, 2009, Florida, and I apologize that not all these numbers are kind of the same time periods, but it's not a dramatically different story if I were to use different ones. Florida gained 1.2 million domestic migrants, 850,000 international migrants. Again, pretty good story of universal attractiveness. So from 2000 to 2009, California gained 1.8 million international migrants while it lost 1.5 million domestic migrants. 600,000 left the Bay Area this period. We lost another 250,000 domestic migrants over the last 5 years when we've been in a boom, okay? This is one of my favorite things. About 1 in 8 net domestic residents left the Bay Area since 2000. Out-migration slowed over the last few years, but it now looks to be accelerating again, I think partially because of the affordability issue. This is another thing. There's a lot of folks who say, well, okay, you've got this, but it's just, I'm going to leave aside the moral value judgment, but they'll say, well, it's just poor people leaving, so that's not so bad. Okay, you do hear that argument from some economists who don't consider any of the other dimensions. But actually, in the last year we have data, the biggest category of out-migration from California is those making 100,000 to 200,000. It's kind of, if you look at Santa Clara County, San Mateo County, that's actually your middle to upper middle class, okay? So we're not just losing like unskilled folks and folks who just, are at the lowest end of the wage pool. We're losing a lot more than that. And I would just argue that an increasing desire for both international and domestic migrants to come to a metro area in a state indicates a healthy economy and society. And when Americans are fleeing elsewhere and only foreigners are coming, I think that signal is much less clear. And that's where we are in California. We don't have the same sort of attractiveness to other Americans as we do to people coming from elsewhere. And that is very unlike, it's not a universal pattern. It's not how it is in Florida, and it's not how it is in Texas, and it's not how it is in a heck of a lot of other states, actually. And this is all from the US Census Bureau that I'm drawing that data a little bit from newgeography.com. Let me talk about not just economics. Last kind of thoughts on immigration is sort of the ethnopolitics, what I'll call them, of immigration in America. This actually came out, a statement after Charlottesville. This is from a woman named Danielle Allen, who's a liberal classicist and political theorist at Harvard. I thought it was the best succinct kind of commentary on Charlottesville in like a couple paragraphs that I saw. But I think it also applies to immigration, a whole bunch of these other very thorny issues that we're looking at right now. She said, "The simple fact of the matter is that the world has never built a multi-ethnic democracy in which no particular ethnic group is in the majority, and where political equality, social economy, and economies that empower all have been achieved. We are engaged in a fight over whether to work together to build such a world, and even those who are in principle willing to build that world are fighting with one another, for instance, over issues such as how the compelling state interest in non-discrimination confirmed by the Supreme Court decades ago interacts with the rights of association and speech. This fight is different than our earlier ones because this time everyone begins from the psychological position of fearing to be a member of a vulnerable minority. Experiences of uncertainty, anxiety, and endangerment are widely spread, and out of such soil grows the poison plant of extremism." And I think that's exactly right. I think that's a succinct, again, it was said originally in the aftermath of Charlottesville, but I think it can expand to talk about a whole lot of the kind of struggles we're having around immigration, around culture, around a whole lot of things. So I just sort of throw that out as I think it's an interesting way to think about some of the problems and some of the reasons why they've become so freighted. And perhaps indicative of this is Harvard, where Danielle Allen teaches. In the class of 21 will be the first majority minority class in history. Non-Jewish, non-Hispanic whites are badly underrepresented relative to their percentage of the youth population. Jews and Asian Americans are hugely overrepresented. Hispanics and African Americans are roughly proportionally represented. If you look at Harvard as kind of like a proxy of elite America in a similar way that, say, Stanford was, again, that's telling an interesting story of where we are as a country, and I think it explains some of the cultural anxieties and other anxieties that we're seeing. So now I'm going to pivot just to economics for a second and give you a few thoughts on taxes, again with the proviso that if you really, really want to understand this in depth, there's obviously better economists and such that you could read that. I'm more of a political scientist. I was talking about the tax bill and was writing about it with a colleague of mine who's a liberal political scientist at Stanford, and we were talking about this provision of the tax bills that I thought people were just running around like chickens with their head cut off, screaming here in the Bay Area because they hate Trump, and they hadn't considered that actually this would be really probably a pretty good provision for most people in the Bay Area. And he wrote, I think quite correctly, I think there's plenty of crazy partisan motivated reasoning all over the political spectrum. People aren't even thinking about what they really believe in anymore. So I'd say with respect to the tax bill, I see a lot of that going on. Again, I'm not saying that's a partisan thing. I think on both sides, I would agree with my colleague. GOP is going to pass a tax bill. I could be wrong about that, but I'd be very surprised. This is now me speaking as somebody who's kind of involved in politics. They just have to, for a variety of reasons. The macro environment is really negative right now for them. The trends are really negative. You could talk to plenty of folks in the GOP, say basically like if we can't cut taxes, we shouldn't even exist. That's sort of their view of the world. And having failed on the Obamacare repeal and other things, they just need a signature legislative win. And so I just start with the assumption that a tax bill is going to pass. It might not, but I think it's going to. On the personal side of the code, just again, this is purely personal view, I actually think it does a pretty good job of slaying sacred cows and touching supposedly untouchable deductions. I have a friend who's a congressman, a guy named Thomas Massey, who's, as he likes to put it, an ideologue and not a partisan, meaning that he's a pretty strong conservative, and that means that he doesn't always make folks in the party establishment very happy by voting the way he wants to, because he tends to vote on principle. And he kind of came on Facebook after the original tax bill came out, and he was kind of shocked, because he's like, wow, we actually didn't put forward a crappy bill from his perspective. I actually sort of agree with him. I mean, there's a lot of things that I don't like. I'd love to see more going toward individuals and less on the corporate side right now. But I think there's a lot of actual things that just purely from a perspective of if you think on the individual side, what you want to do is lower rates and get rid of exemptions because that's just a healthier way to do things. There was stuff that I never thought that they would touch. Stuff that, oh, you can't touch that. They touched. So I actually think that there's some good things there. However, the existing plan is certainly not friendly to California. And if it were, GOP should be sued for political malpractice. You don't like help out the people who overwhelmingly didn't vote for you. You help out the people who did vote for you, and hopefully, as at least a side effect, ideally as a primary effect, you also do good policy, right? So that's the reality. Is I think this is not going to be a bill that's going to take certainly particularly like the upper middle class and up in California and be super friendly to them. Upper middle class and up in California is a little bit of a cash cow on the personal end of this bill. We can talk about the specific provisions if people want to get into that. That having been said, it'll probably benefit the California middle class and renters. And by putting significant downward pressure on California housing prices, which I think it will do, it will actually make housing more affordable while reducing windfall profits for current homeowners, okay? You read a lot of stuff in the Chronicle and Mercury News, and it's sort of, it's Armageddon, for homeowners, weren't you just writing like last week about the housing affordability crisis? So it's not clear to me that as a macro level, a bill that puts downward pressure on the most inflated real estate markets is necessarily a bad thing. Now, if I were a real estate agent, I would have a different view of that. But as both a piece of policy and as a macro political economy thing, I actually think that's a feature and not a bug of the plan. Key amendment will be to see if what's now called the Rubio Lee Amendment, I think this will be a good test of like the quality of ultimately what happens, or something like it gets traction. And this is a huge split for conservatives right now between what I'll call pro-business and pro-family constituencies. I'm just using those as shorthand. So the Rubio Lee provision, for those of you who don't know, it's for Marco Rubio and Senator Mike Lee from Florida and Utah. They have really been pushing a greatly expanded child tax credit, and one that would be refundable, and this is where the real controversy has been, against Social Security taxes for those who don't owe personal income taxes, which, as everyone should know after Mitt Romney, includes about 47% of American households filing. To do this, they've argued that we should cut the corporate rate from 35 to 22% versus 20%. And the Wall Street Journal editorial page is like fighting with the National Review, and there's all sorts of interesting things going on the right. I don't think that Rubio Lee will happen in the form that Rubio and Lee want it to happen. But they've already gotten more. There are various things with this child tax credit where it's already going to double, and the income threshold has actually gone up a lot. One of the friendliest things for the Bay Area, the income threshold is going to be $500,000 for getting to take that credit at now $2,000 per child versus $1,000. So that will actually make a notable benefit. I think the old income cutoff is like $130,000 or something for a lot of folks. But I think getting a little further toward what Rubio and Lee want will be a sense of whether this will be a good bill for the GOP politically. Right now, I think, regardless of what you think about the policy of reducing a dramatic reduction in corporate income taxes, the politics of giving so much on the corporate end and so little, comparatively speaking, on the individual end, I think will not be a recipe for success. And I think if just politically, it's just a personal view. And so I think if you see something like Rubio Lee get a little closer, that would be a good indication politically that they're going to pass a bill. Because if they do that, middle-class families who are working and working-class families are really going to see a very substantial short-term benefit. Whether or not it's good macro policy, we could talk about. So I think that's a particular thing to watch. Home mortgage and local taxes will make it much tougher on high tax states like California, and I think it may pressure policy changes. Wealthy taxpayers are going to feel the bite of California state policies more. Right now, fine, you had a top marginal rate of 13.3%. I'm writing all that off of my federal taxes. So it's not that I'm not seeing it, but I'm only seeing a portion of it. That goes away, and all of a sudden, there are going to be a lot of people with money and influence who are going to be a lot more unhappy with the amount of money they're giving to California state government. I think that's going to have a bunch of interesting policy side effects that have not really been publicly aired yet at this point. So I think it could upend some interesting debates on state and local taxation, and I think there'll probably be some property tax relief put back in. That seems pretty likely, but I think so-called SALT, state and local tax deduction, I think is going away. I think that's good policy. Personally, I also think it's good politics for the GOP. People may feel differently, but it's not necessarily going to have a wonderful effect on this particular state. But ultimately, I would say, as you think about how you might think about this bill, the corporate taxation piece is the centerpiece of this bill. That's certainly how people in the party think about it. And I should say, genuinely true believers, you read like all these, I can read these things on the left, and they just want to give money to ultra-rich people and take it away from working class. I can tell you, having talked to the most passionate defenders of the corporate cut is, they truly believe that they're doing this, and this is going to spur growth, and that's going to create jobs and a stronger economy for everyone. I'm not going to take a side on that right now because it'll play out, I think, but the corporate taxation piece is the centerpiece of this bill. And if you believe that reduction in corporate rates is going to lead to growth, and I don't think anybody argues, we have the top corporate rate at the marginal level in the entire developed world. So I don't think anybody is arguing that that shouldn't go down, even though our net effective rate is not as high. But I think if you believe in that, you like this bill, and if you don't believe in that, you don't. Okay, it's just as simple as that. And I think we're going to get a natural experiment. We're going to see. Growth has picked up, I'd argue partially anticipation of some of these changes, and we'll see what it actually looks like when it gets going. So where can the business community provide leadership, just to close? First, I think we can recognize that economic growth needs to serve the interests of people, and building the next great wave of inventions is wonderful, but if Americans are leaving our community in large numbers, I think we're doing something wrong. We need to change, just bottom line. I think we need to promote a real grand bargain on immigration, which doesn't mean like the GOP gets everything it wants, and it doesn't mean the Democrats get everything that it wants, but it means that you depressurize this issue by focusing on the welfare of Americans broadly. In what we put together, I think we need to have a reduction in low-skill immigration that depresses wages for working-class Americans. We need to have enforcement of our current immigration laws, Canada-style, Australia-style, H-1B reform. I think it's not the fake grand bargain that's been pushed in the past. Fake grand bargain is one of the things that got Trump elected, because voters saw through that. I think in that environment, a deal on DACA, a deal on Dreamers absolutely gets done. And I think business can absolutely be a decisive voice in making that deal happen. I absolutely do. I think if business is willing to deal, that will be the indication that we'll push Republicans, and it will push enough Democrats as well. And I think, personally, institutionally, and a recognition that racial dynamics in modern America fit Danielle Allen, that's the woman at Harvard I mentioned, framework far more than the simple white supremacy narrative that I think we're seeing a lot of on the left. I don't think that's productive for really getting anything done as a country. Just, again, a personal view. I'd love to bring more actual diversity of thought to the tech and business leadership, not just how we do diversity today. People of different skin colors, sexual orientations who largely think the very same way. Actually, just interestingly and encouragingly, I was sitting on an Aspen Institute event this week with the head of diversity for eBay, who's an African-American guy, and he has a lot of experience in this area. And he basically said the exact same thing. So I thought that was encouraging that at least some of the companies in this area are taking a broader view of what diversity should really mean. And then I think finally, we can push for more federalism in government, which means more local control. Part of the reason why everybody's so unhappy about government right now, this is another thing that came up in the Aspen Institute meeting, is that there was a book written by a conservative journalist called "You Will Be Made to Care," and it was sort of for people saying like, "I don't care about X issue," and he said, "No, you're going to be made to care," and that's because we've so lost the idea that in this country, hey, maybe the Bay Area is going to do things in a certain way, and that's not going to be how Tulsa is going to do it, and that's not going to be how New York is going to do it, and that's not going to be how Denver is going to do it, and past a certain point, because you do need certain basic rights enforced without question in this country, that's okay. And part of the problem is we've centralized everything so much in Washington, all the power, all the money, all the influence, that we're made to care. And if the people who are in Washington are not people we like, life is horrible. It sucks for us. We turn on the TV and we want to throw things at it. And it would be better if we moved away from that world and moved as much as possible toward a principle of subsidiarity, which is what it's called technically, where things are decided at the lowest possible level, the most closest to local level that they can be competently decided. And I think, broadly speaking, again, not trying to be partisan about it, I think everyone would be happier if communities had more choice in how they lived and less dictates from Washington, D.C. So that's a very big picture talk. Hopefully it's at least informative or provocative, and I'll be happy to take any questions. Thank you.
So we are going to offer the audience one or two questions. If there's someone that I see, Jonathan Scharfman in the back.
Yeah, Jeremy, it's curious to me you didn't touch on infrastructure. Could you comment on where you think the administration is going in 2018 on that critical issue, not just for California, but for the nation?
Yeah, great question. And again, I started out saying this is an impressionist portrait that's more like stuff that's interesting to me that I know about. And so not in any way comprehensive, but infrastructure is a key piece. Look, I think this president is a guy who made his career putting steel on the ground, okay? Also selling off his brand name, but that's a separate thing. I think he wants to build. I've been a little bit surprised that we haven't seen that more front and center, in the same way that I think Rubio Lee and a more pro-family tax policy would be very good for a lot of the constituents he wants to reach. I think for lots of reasons, infrastructure would be good. I think it's a rare area where you might see a deal between Trump and the Democrats, and I think it's just going to be whether the degree of personal antipathy that has been built up on both sides can kind of be put aside enough for people to do a deal that, frankly, I think both sides want to do. If anything, I think the Republicans are more reluctant to do that deal than the Democrats are. But I think we'll see something. And I think that'd be good, broadly speaking. It depends on how it's done, and it depends on, if it's all feather-bedded union contracts in California, in my view, then maybe it's not so good. But we could certainly do a lot of things to repair our infrastructure, and it would put a lot of folks to work. And I think, I'm both optimistic about it as a personal thing, that I think it could be good policy, and I'm optimistic that, again, if we could just calm down a little bit, that actually this is an area where there's some commonality of interest and we could get a deal done.
Do we have one more question for Jeremy? Okay, if not, then let's thank our speaker.
Thank you. Yeah.
Hi, my name's Steve Elliott, and I'm the chairman of the Redwood City, San Mateo County Chamber. And I'd like to thank you all for coming, first of all, and I also like to give one more round of applause to our fabulous speakers and Roseanne for moderating today. And of course, I want to thank Amy and the chamber staff, Roseanne and the SAMCEDA staff for putting together this great event and thank Oracle for this wonderful room. And finally, before I let you go this morning, two major announcements. Put on your calendar the 49th Annual Progress Seminar on Friday, April 13th through Sunday, April 15th at the Hyatt Regency in Monterey, and SAMCEDA's Innovations, SAMCEDA Awards of Excellence 2018, Friday, March 9th, 2018, from 11:30 to 1:30. And with that, I will let you go, and thank you for coming.